the shutdown is not good, but my bigger complaint is that America, maybe because of partisan politics, has been unable to do a lot of things that need to be done. So you had some tax reform, you had some regulatory reform, but infrastructure, we put a man on the moon in 8 years. It takes 12 years to get the permit to build a bridge.
Right. JPMorgan Chase CEO Jamie Dimon revealing his concerns to our own Maria Bartiromo. Is he right? Of course he is. James Freeman is back with us along with John Lonski, Moody's Analytics Managing Director, Chief Capital Market Economist. I mean, he really hit the nail on the head there, John, with why this whole thing is so frustrating, because it illustrates kind of what's been squandered recently. We were on our way, tax reform, regulatory reform. We need some infrastructure, and then boom, we kind of can't get together to do the rest. What are your thoughts?
Well, you know, we have run into some very serious budgetary constraints. He's talking about putting a man on the moon from the 1960s. Back in the 1960s, the federal budget was roughly in balance. Today, we have a federal budget deficit that in a couple of years should approach $1 trillion. So it's yeah, infrastructure is a great idea, but who's going to pay for it? Especially in a time where everybody wants something from the government without paying for it, without having to pay higher taxes.
But, James, you know, we were moving closer to things being better, you know, in terms of ripping down some of the regulation that's gumming up the works, freeing up people and corporations from the burden of taxes. And then once again, the government kind of, you know, got all gummed up in its own problems.
Yeah, it is a partisan issue. You basically have very few pro-growth Democrats left. That's why the president had to do tax reform on a really partisan basis. You could not find Democratic votes for cutting taxes. And the deregulatory effort has basically been partisan as well. There are not a lot of Democrats who will be willing to say they want to cut government red tape. You're going to have the same problem here because, yes, you have a fight over the money. Democrats want it to be all government funded. White House wants infrastructure to be mostly private funded. But the big dispute is going to be about just what Jamie Dimon is talking about, is an unwillingness on the Democratic side to clear away years of fights over environmental impact statements and all of the regulations that prevent you from building in the United States.
Meantime, Jamie Dimon also offering insight on the Federal Reserve. Take a listen.
Regulatory policy and monetary policy are interlinked in a completely different way than they were before. And I don't fully understand the full effect of that. So I do think reversing QE in a different regulatory environment may have a different effect than we think. But on the other hand, the Fed's not going to sit there and ignore it.
So, James, that's the unknown.
Yep.
As you unravel, we have no idea what that's going to mean in this regulatory environment. He went on to say that he feels like, and he's a guy who sells money, that he feels like the 10-year should be at 4%. But he goes, but I don't know, because all the rules have changed. What's your take on that?
Yeah, I'd say so far so good in terms of transitioning back to a real economy from the previous era where it was kind of the Federal Reserve trying to conjure prosperity by printing lots of money. The Federal Reserve has never created so much money. And so it is uncharted territory as we try to go back to normal. The Fed's balance sheet shrinks. Interest rates have to rise. I think he's thinking about what is normal going to be now. But I think so far you have to be encouraged about how we've gotten good growth and job creation and not inflation.
John?
Well, Jamie Dimon, like a lot of economists, is scratching his head, wondering why bond yields aren't higher.
Yeah.
But you know, recently we did have the 10-year Treasury yield move above 3%. But in response, we had a reduction in unit sales of housing. Mortgage credit began to slow down, began to collapse. What we're finding out, today's world is different in a very fundamental sense. Because we're so much more highly leveraged, because we have an older economy, the U.S. economy's sensitivity to higher interest rates is greater than it was in the past. And thus what we're finding out is that the upside for bond yields, for the federal funds rate is limited. And of course, making matters worse right now, not only is the federal deficit widening, and that's putting upward pressure on Treasury bond yields, but at the same time, the Federal Reserve is shrinking its balance sheet. That is, it's increasing the supply of tradable Treasury bonds, and that also has the effect of putting upward pressure on interest rates.
Yep, and all that's got to settle out. Gentlemen, thanks to both of you.